With supply shortages hard to hide, impossible to hide, and just about every single bullion bank long silver for their own books, which we've been tracking for a long time now, we actually had the ingredients for a rally into the season.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
All right, welcome to Live from the Vault, brought to you by Kinesis Money. And this is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And as you can see, I am out of the vault today, and I'm visiting one of the seventh wonders of the world here in Niagara Falls, Canada. And joining us today is, I believe, the eighth wonder of the world, Kinesis' own and a world-renowned whistleblower and precious metals expert, Mr. Andrew Maguire. He's in the vault, and this week we're going to be discussing not only gold, but we're also going to be discussing silver. So let's head over to the UK with the one and only Andrew Maguire. Now, Andrew, by the way, this week, most of our community questions revolved around silver, believe it or not. And we want to remind, by the way, our community here to keep those questions coming, all right? All you got to do is look at the link below. Go ahead and hit that link and you can record your own questions. And who knows, Andrew Maguire might answer your questions. So with that, Andrew, by the way, last week on our very last episode, you said the gold and silver ratio trade looked like it was unwinding and that silver looked like it was about to break out higher with silver priced below $38. You said it was unsustainable, below $38. In fact, your chart suggested $40 as very likely or highly likely. And then since then, maybe the Bank of America watched your show or watched the show here on Live from the Vault, because now they're saying $40 silver looks very likely. So do you think silver is going to outperform gold over the near term here moving forward, Andrew?
Yeah, great to be with everyone. And let's get these. I know there's so many questions that came in. Thanks for amalgamating them really there, Shane, because silver was right on the front burner. I know you love that subject. And it was only 2 weeks ago. We did say we were looking at for the commencement of the long-awaited silver breakout. So what we're going to do is we're going to answer these questions, but we're going to look at, in order to answer it, we're going to look at our first-tier liquidity provider feedback around this subject, along with, obviously, then we'll look at gold support levels as well, which is, of course, following the usual bid pulling session after non-farm payroll. So you always got some volatility. So to answer the question, yes, the footprints were pretty darn clear. When we recorded that last episode, silver was evidencing strong Chinese, Asian demand, but it was at $33. But with supply shortages hard to hide, impossible to hide, and just about every single bullion bank long silver for their own books, which we've been tracking for a long time now, we actually had the ingredients for a rally into the season. In fact, so much so, it turns out the banks have actually front-run the July season by a full month. Normally we see silver strong in July. So perhaps a quick look at the charts would actually be helpful at this stage. So just to make a note, this is being recorded on Wednesday. We've just had CPI, the CPI print, and so this will be released on Friday. So just be aware that is the time we're recording this. And it's really more important to look at the general direction and what we're expecting. And in fact, the very first sign that the bullion bank cartel was planning to short cover ahead of season was on the first trading day of June, which was here. And where spot silver took out the next round number. If you remember, we've been consolidating. When we were talking about, in our last episode, we were talking about the 33 spot level. These are futures charts, so there is slight adjustments because of the contango between futures and spot. But essentially, on the first day of June, suddenly we blew through, or silver blew through, the 34 spot level, which is approximately $34.08 in futures. And not only did it blow through, and it immediately has now become support. So I didn't even get down to testing it before it was front run. Normally we see a pullback, So essentially that is where we first saw the rally. Then once again, now last Thursday was interesting. This is really when silver's mispriced 14-year underperformance breached the large resistance at $35. We saw the $35, which is right here, and actually hard testing and really triggering short stops at $36. Now the contango expands a little to 12 cents at that price, and it will in fact expands a little bit more to 14 cents when we get up towards 37. But essentially, this is what we were looking at. And this has created a historic inflection point. And guess who was on the short side? It was actually the siloed speculators here and here that got royally rinsed. And what we've evidenced is really this inflection point. We're talking about the cartel having repatriated sufficient bullion. Collectively, they've allowed silver to decisively break out of a 14-year capped range. And so really, when you think about it, we're now dealing with a 14-year cap range. In fact, on Thursday, silver futures went bid only, forcing a massive short squeeze upon sleeping specs who'd become acclimatized to selling billions of dollars of bets against silver rising out of this 14-year capped range. Now, as we know, and we've done in episodes about this before, it's the highly leveraged options traders that get carried out feet first, because when the leveraged cash bets they have made against whatever the asset class is, but in this case it's billions of dollars of paper bets against physical silver, and once they're called in, it happens all at once, and the market can suddenly go bid only, and losses to buy back these naked short bets can far exceed enough cash reserves to close these bets. In other words, it can bankrupt the short seller. Most people think of options as buying options. Now we're talking about aggressive selling options at the top of a sequential range in the hope that it will come back down, and it has worked well for them. But when it goes bid only, look at what happens. Now we're in the process of seeing the first two signs of going bid only. Now, given there are several naked short CTA structures, commodity trading advisor structures still vulnerable for margin calls, liquidity providers are betting we may see some further bid only setups developing. Now, while these speculator bets are little more than collateral damage around what is really a multi-year Fed-held OCC FX bets against silver, and we talked about the OCC FX bets, which are largely in the Fed's hands, and they can obviously, because the Fed's controlling them, they can be cash settled by way of a series of keystroke entries, much as we saw when that happened after the Shanghai Futures Exchange caught the short sellers wrong-footed, and really then we saw this sequential series of higher stair steps devolve. Now we're seeing similar action in silver, and what that's going to do is when these bets are settled, even though they're cash settled, it's going to force much, much higher prices. Now, while the headline data evidences the silver cartel is now building one of the largest ever short positions against a race by speculators to now chase a rising price, because silver now looks like it's going to even outperform gold at this point, and due to position concentration, there'll be an opportunity for these agent bank pit managers to orchestrate some wash and rinse cycles along the way. And we've seen a little bit of that here, but we think it's going to be, they're not going to go naked short. And so what's happened is, really, when we look at these bank positions, they're actually, because they're long their own books, what they're doing is they're hedging. These shorts are hedging physical positions. Now, obviously, they're not one-to-one, but they're not naked short, which means that dips will be shallow. To explain this, it would be a good idea to address the gold-silver ratio part of the question. Now, most of these official derivative bets against silver have migrated into the ratio trade, driving an otherwise implausible gold-to-silver disconnect where it's taken up to 120 ounces of silver to buy just 1 ounce of gold. And while this has now begun to unwind, it still requires over 90 ounces of silver to buy 1 ounce of gold. That is unsustainable. And the level of synthetic silver leverage is just not plausible. And while the natural ratio should be, say, 10 ounces of silver to buy 1 ounce of gold, valuing silver at current gold prices at $300 an ounce, liquidity providers figure an interim gap close to 35-1, which is pretty much what we saw at the end of the 2011 sell-off, which was the sell-off from $50. And even with gold currently at underpriced levels, it would put silver at $100 an ounce. And that is realistic. Now, the gold-silver ratio trade is now actively in the process of harvesting asymmetrically imbalanced short bets against silver. So bottom line, silver's short hedge against gold is being called in, which involves selling gold to buy silver. So you see a bit of weight on gold. But this inverse trade has massively expanded after the bullion banks came out of the gate last Thursday, literally to buy silver, and involved selling some gold. Now, short term, as silver is left to run higher to begin to close the imbalance, obviously it's weighing on gold a little. And the activity we're seeing now is the usual volatility around CPI. Even though it was a miss, you get the usual gaming around those levels. So there we are, gold and silver as we are today. However, with China actively alchemizing this synthetic imbalance, buying both physical gold and silver, both gold and silver are in the process of securing higher physically supported stair steps. Now, this is the core reason why the silver cartel is not naked short silver against a rising price. Now, notably, we're now evidencing silver being talked up, just as we experienced in gold when the bullion-backed cartel moved to become fully Basel III compliant. Now, realizing the BRICS physical market dog was actually wagging the shrinking COMEX derivative tail, and they had built up very long in-house physical gold positions, if you remember. This is when the cartel of bullion banks began publicly talking up their long gold book. You remember, they were talking about 4,000, 3,500, 4,000, 4,500 even. Now, similarly, having now also run out their naked short silver book at the expense of actually a dwindling volume of short speculator open interest left to actually short cover into, collectively, these same bullion banks who have stealthily built very long in-house physical silver positions, they've started to come out publicly too, to also talk up their long silver book. And yes, there's going to be opportunities for the cartel to rinse out some low-hanging momentum longs because they're going to jump on board for the ride, and they're going to borrow silver from the bullion banks. So obviously there'll be some targeting of that along the way. But let's look at why those dips are actually going to be shallow. And in the past, we've seen huge discounts following through. Now, while silver is not technically, of course, Basel III compliant, unlike commodities, it also trades as a foreign exchange cross, which means that the silver leg of the currency cross, because it's money, benchmarks the unallocated silver price at the fixes. It's money. So due to its unallocated nature, though, and we've seen up to 500 to 1 derivative flywheel being employed, the silver cartel has been able to historically cash settle, roll, and generally ring fence silver from ever breaking out to find its true supply-demand price. Now, anyone who missed the bullion-backed explained link in the last episode can find it. It is there, or there's also a link on that episode, but there's also, you can find it on the GATA website. Really important to understand. That is the cartel's strategy, which I think they wished they hadn't published that. However, just as we witnessed in gold after physical gold was offered at the fixes that became actually Basel III compliant. So remember, we're talking physical gold here, is Basel III compliant. There's a realization that BRICS physical market, the BRICS physical market silver dog now has started to wag this COMEX derivative tail. And having built very long in-house physical silver long positions, the cartel, and I mean talking physical, these cartel of bullion banks have begun publicly talking up their long silver book. Now, as we've been reporting for quite some time now, it's the commercials, the COTs, who've been on the long side of the options calls. Now, these are options calls that were not just bought, but sold by the speculators. And what the commercials did, they lend these to the chart painted specs who've just been acclimatized. It's going to knock back down. We can guarantee 6 months, a month from now, 3 months from now, even a year out from now. Well, let's just place big bets against it, ever breaking out, because it'll come back to us. And now these market-making bullion banks are now faced with two choices. They either face delivering their own silver into this rising price into BRICS exchanges, or they enrich themselves by letting the foreign exchange settlement price become deliverable at a real supply-demand price. Now, it's not only going to happen, it's not going to happen overnight. Let's talk about 50 years of history here. But with the allocated silver and mine supply increasingly flowing into and being priced into Chinese BRICS-facing physically settled exchanges, the legacy LBMA cartel is being starved of sufficient supply to keep unallocated silver from escaping the cartel's ring fence. Now, clearly, it's been extremely profitable to contain silver inside this 50-year siloed cash-settled range. But with silver and gold prices increasingly being settled in physical exchanges outside of the cartel's ring fence, they will have to shut the door on this extremely profitable 14-year containment range and allow silver to break free. These pit managers have no choice but to ring the register on any remaining gaslighted, blinkered speculators into a relentless, very strong BRICS physical silver demand. Now, the global FX price is being set loco London, but is deliverable outside the LBMA ecosystem. It sets the global price. And what that does is expose the cartel to the short side of the global facing FX silver demand. And they cannot fulfill those deliveries at current prices. So they're increasingly forced to convert leveraged, unallocated positions for delivery. You think that's coming out of their own stocks? No way. The only way to do this without delivering their own bullion hoards is to ring the register on all the gaslighted CTA specs that have bet into this, who've really leaned into this 14-year bear market position. In fact, the liquidity providers assess there's more to be gained by ringing the register on any remaining CTA specs, and there are some, still betting against silver, then actually it's better to let it rise than continuing to cap it. It's more profitable. Now, following January 2023 Basel III gold compliance, we've been reporting that every single bullion bank has also been stealthily going long silver for their house accounts. And with spec open interest now too thin to maintain the very profitable 14-year cycle, wash and rinse cycle, a slew of LBMA bullion banks are publicly breaking rank. Now, last week, the Bank of America openly called for $40 silver and $4,000 gold. And nothing new in that about gold. But silver surprised a lot of people. And funnily enough, their advisory, by no coincidence, jived with Goldman Sachs, aggressively talking up their long house account silver book. And that is house account. And as we've been reporting by way of our Goldman Sachs liquidity provider for some time, the in-house Goldman Sachs advisory for their clients to get long silver has actually been in place since April. I don't see any surprises here. However, last week's public advisory, that is, ahead of non-farm payrolls, which is most unusual to see a move before a non-farm payrolls, which of course they would have had the data of ahead of time. But it not only spilled the beans on, quote, staying long silver, as they put it, but also advised holding fire on adding longs until the bid-only short squeeze played out in full. And then they said to Action, quote, significant spot and futures long additions should be initiated. Now, our close contact, Goldman Sachs liquidity provider, figures this advisory to instigate fresh silver positions will be announced when silver tests $40, which clearly indicates they expect a gap close to $50, which will quickly follow. Obviously, along the way, we expect the cartel to also rinse out any fresh spec longs they can, but with the unallocated to physical lines actually now crossed, collectively, there's far more to be gained to see silver above $50. So dips from here on are going to be bought. And obviously, that is something that is going to offer opportunities. So bullion bank targets of $40 look compelling. However, tagging $40 will spill blood in the water, attracting momentum-fueled sharks who will undoubtedly want to test for stops by stops above all-time highs before seeking to ring any kind of register. And as we've evidenced, at every spot round number being taken out, pullbacks to these round numbers have become bricks-centric supports. And once 40 becomes support, and once those stops are breached, it will become support. And the rally to close the $50 gap will commence. The bigger clues are all there. So while gold has been contained between 3,300 and 3,400, still is at the moment, silver has finally broken out of, and it's been tripping off very large official shorts related to the gold-silver ratio trade. And while currently contained at and below the 36 level, the odds of targeting the next layer of short stops at $38, which we talked about last episode, opens up a path to $40 sooner than the market is actually currently structured for. So really, in summary, while the unwind of the ratio trade is short-term weighing on gold, Asia is buying, and higher stair steps are being anchored in both. Following the bullion bank advisories, silver open interest, the silver futures open interest, which is easy to track, has ramped up significantly, as you can see here, with the CME physical silver cover also ramping up into a race to repatriate. Now, we're recording this episode on Wednesday the 11th, and as of yesterday's data, the 4-week change in the SLV ETF exchange evidences an inflow of over 690 tons, with actual total net inflows with all of the various ETFs, etc., at 1,073 tons. That's the 4-week change. That's a 4-week bullish change. Now, whereas gold open interest has stayed muted, evidencing the gold-silver unwind, the short squeeze is underway. So gold is coiling for an end of second quarter rally.
All right, Andrew. And again, the majority of our questions this week were all about silver. So thank you so much. And I'm sure we've answered a lot of questions with that answer. Now, Andrew, what are you seeing now in gold moving forward?
Right. So medium and longer term. I mean, look, ignore the chart chatter. We had CPI today. It shot up. It came back down. I mean, basically the algos are at work. So ignore the short-term chart chatter. We're looking medium, long-term. Gold continues to coil extremely bullishly for a very strong end-of-year close. Now, while very short-term feedback from our physical-facing liquidity providers indicates that while the banks lean into this unwind of the ratio trade, commercials exposed to a growing wall of still undelivered T+1 delivery obligations will be short covering at and below any dip into 3,300. That is, we've been witnessing that for some time. And note that pretty much all the last 10 or 12 fixes have been above 3,300. So there might have been dips below, but this is all game stuff. They don't really want to deliver central bank size into where these orders are, at the fixes, that is. Now, given the consistent Western capping attempts, as we outlined last time, we had pointed out China's change in strategy from the immediate buying Western end of session dips. So the West sells at the end of the day, and then Asia, we used to be quick to buy it. And we talked about this strategy change last time, where they reverted to employing late buying, allowing the West to continue to, and obviously we're talking about, there's two different categories here. There's speculators will come in and buy straight away. But we're talking about the institutional money, the pension fund money, the central bank money, sovereign-sized money. What they're doing is waiting until later in the session, and so to capitalize on these dips, and reverted to employing into, then what they would do is, then you'd see a well-attended AM fix. So that was their strategy. We outlined it last time. Now we continue to evidence this. However, once 3,500 gold is breached for a fix, we expect Chinese traders to front run a race to 4,000. Now we saw it when the Shanghai Futures Exchange launched. We saw the relentless buying, momentum driven, but long enough at each stage to bring the physical level, the support levels higher. That's how stair steps are formed. And when we look at the COMEX data for gold, the distinct lack of, you see it, of long Western market participation is incredibly bullish, as it limits the sell ignition triggers. In other words, bid pull, try and target some stops, long stops, create this sell ignition. Everyone races to get out. It makes it very difficult. So therefore, the dips are shallow.
All right. Now, Andrew, we continue to see efforts by the LBMA to try to spin that gold all of a sudden is not Basel III compliant. I strongly suggest that those trying to make sense of this go back and look at your full explanation on how and why the gold cartel is trying to spin this misinformation and this confusion here. I'm sure maybe we can leave a link below, but over to you, Andy. What do you think about this?
I see this headline pop up all over the place. It's almost a daily thing. Actually, it's even getting bloggers to perpetuate this. Actually, their smoke and mirrors spin aside, gold's Basel III NSFR compliance can be really summed up quite quickly. I mean, let's face it, the task for Basel III all along was, and still is, to de-risk the global banking system. But the significant danger that they have discerned is the multi-trillion-dollar uneven gold derivative positions, the unbacked ones. Now, the LBMA is deliberately avoiding the mammoth in the room, namely that allocated gold held in any global vault is fully Basel III compliant and meets the standard of both a high-quality liquid asset and a first-tier asset. This is the only gold that matters, because the first-tier bullion bank liquidity providers providing liquidity to the T+1 deliverable global FX gold fixes, where central banks and sovereign buyers lock in supply, has to be NSFR compliant. And they do have to have this allocated gold to back up these fixes. So it is, by default, it is allocated and it meets every standard. Now, what the LBMA is trying to draw attention to is unallocated gold held as collateral amongst the clearing banks, and it's subject to a haircut. We're deliberately ignoring the gold-facing central bank in institutional demand at the fixes. They're ignoring the fact that the gold that faces the fixes is Basel III compliant and is allocated and deliverable. The reason the LBMA wants to prolong this unallocated shell game, we talked about it last time, is largely at the expense of the captive producers, which they finance. Unallocated gold transactions, their forwards, etc., are netted out amongst the cartel's shared books of their book of business, and essentially it gets a 20% haircut, which in turn enables them to further leverage these positions at around 100 to 1. Again, look at bullion banking explained. It's all in there. Furthermore, as we outlined over the last few episodes, Chinese and Asian-facing fully allocated physical kilobar markets, including several new Western-facing physical exchanges, the latest being the physical allocated ABAX spot gold contract that just launched on June the 12th. That is tomorrow for me, but it'll be in the rearview mirror for you. All of these fully allocated exchanges are 100% Basel III compliant and physically deliverable, and are now hugely influencing the fully allocated gold being settled at the global-facing local London fixes. China has long been doing Basel III's work. They just simply are alchemizing the Western non-compliant unallocated gold and forcing delivery at the fixes. Shame on you, LBMA. So basically, I'll just leave it at that. They should be ashamed of themselves. And of that note, what we're doing, though, is really witnessing a closing window of opportunity here at a major inflection point in both gold and silver, where sufficient physical market liquidity will force gold and silver to discover their real supply-demand prices. It's not going to happen in one day, but it's happening. So with that in mind, there's just one question left to ask. How much physical gold and silver do you own right now?
All right, that wraps up another episode of Live from the Vault, and a big thank you to Andrew Maguire for sharing his market knowledge, and thank you for tuning in and being a part of this growing global community, and it is growing. So if you're new here, by the way, make sure you hit that subscribe button, tap on the bell so you never miss an episode. We'll inform you right away as soon as the episode goes live. And if you've been here for a while, please help keep spreading the word by hit that like button there. It's easy to do. Just hit the like button. It really helps the algorithms. And also share this episode with someone who really needs to hear it, and get your questions asked. By the way, all you got to do is look at the link below, get a question for Andrew. Who knows? He might even answer your question on our next episode of Live from the Vault. So we'll be here again next week with more truth that you won't find anywhere else. And until then, remember, buy physical, make sure it's backed 1-to-1. We'll see you then. Bye for now.